Hello and welcome to SKANS eCampus. SKANS eCampus is a gold-approved learning partner of ACCA. On this channel, we bring you demo videos of different courses available at SKANS eCampus. So don't forget to subscribe to our channel to get notifications of additional videos and hit the like button.
So here comes the concept related to the computation of capital gains tax liability. So whenever an individual will be selling off chargeable assets in a particular tax year, we need to determine gains of those assets and we need to add them up in order to come to know what a total chargeable gain figure is. Against the chargeable gain figure, we need to deduct an annual exempt amount, and for the tax year 1920, annual exemption figure is of £12,000. After deducting annual exempt figure against total chargeable gains figure, we come to know what a taxable gain figure is, and this is the figure on which tax rates are to be applied. So when it comes to the application of the rates, we need to see whether the taxable gain is going to fall in the basic rate band. By the way, one should know that basic rate band has to be utilized by a taxable income for the sake of calculating income tax of an individual. But if some of the basic rate band is left, then it will have to be used for the sake of calculating capital gains tax liability. So we need to see that if there is found to be an available limit in our basic rate band, so whatsoever the portion of the gain falling in the basic rate band, we need to apply a capital gains tax rate of 10%. But if the taxable gain would not be falling in the basic rate band, then whatsoever the gain is going to be adjusted in a high rate band will have to get taxed over a rate of 20%. So these are the rates which we have to normally apply over the disposal of assets, but there is a different situation as well with respect to the application of taxes, and that is found whenever we are going to sell off a residential property. So where an individual will be selling off a residential property, then we need to decide whether the gain is going to fall in the basic rate band. If yes, then the tax rate is of 18%. While if the gain has not been adjusted in basic rate band, then it will have to get adjusted in high rate band where capital gains tax rate is of 28%. Let's take an example. For instance, for the tax year 1920, Adam has a salary of £44,000. Keep one thing in mind, that salary is something which belongs to income tax computation, and during the year he has made net personal pension contributions of £4,400. As what we have discussed before, the gross amount of personal pension scheme would tend to increase the available amount of basic rate band limit. On 15th June 2019, in the same tax year of 1920, Adam has sold an antique table, and this resulted in a chargeable gain of £21,000. So first of all, I need to see that Adam must have calculated his income tax liability, and he would have surely used his basic rate band first for the sake of calculating his income tax liability over his taxable income. So I just need to know that what is the available amount in the basic rate band. Normally the basic rate band is having a capacity of £37,500, but there we have to add a gross amount of personal pension contribution made by that individual, which is, as quoted in the question, is £4,400 being a net value. So I need to multiply it with the fraction of 100 over 80 in order to come to know what a gross figure is. So gross amount of personal pension contribution is of £5,500, and this is how you can see that the basic band has been extended to £43,000. As Adam has got only one source of income, which is his salary, and there is no other income to be found over here, so this could be called as his net income. And against net income, we need to deduct the personal allowance figure in order to determine taxable income, and the personal allowance figure, as we already know, is of £12,500. This is how his taxable income was of £31,500, for which we need to apply basic rate band first. As now the revised limit of basic rate band is £43,000, out of which taxable income will have to be utilized first, and after that, we'll come to know that there is still £11,500 available in the basic rate band, which are to be used by taxable gains of Adam made in this tax year of 1920. So as his net chargeable gain is of £21,000, against this figure, we need to deduct an annual exemption figure of £12,000. And there we come to know that the taxable gain figure for the tax year 1920 is of £9,000. As sufficient amount is still there in the basic rate band, so the whole £9,000 is going to be covered in a basic rate band, and this will get taxed over a rate of 10%. As this is not mentioned in the question, the disposal was related to residential property, which is why I would assume that something other than residential property has been sold, and the whole gain, as you can see, is going to get adjusted in basic rate band, which is why a basic rate of 10% will have to be applied over £9,000, and this would result into a capital gains tax liability of £900. There comes another example. For the tax year 1920, B has got a trading profit of £60,000. And on 20th August 2019, she sold an antique vase, and this resulted in chargeable gain of £19,800. So once again, as the chargeable gain for B for the tax year 1920 is of £19,800, against which we need to deduct an annual exemption figure, that's of £12,000. So we come to know that the taxable gain figure is of £7,800. But before the application of tax rates, we need to see that how much basic rate band has already been used by her for the sake of calculating income tax liability. So as you can see in the question, that she has got only one source of income, and that's her trading profit, which is of £60,000. So we can also call it as net income because there's no other income found in the question. Against net income, we need to deduct the personal allowance figure, and there we come to know that her taxable income is of £47,500, which you can see that this figure must have consumed the total amount available in the basic rate band, which is of £37,500. So this 7,800 will have to be adjusted in a higher rate band where the tax rate is 20%. So this would result into a capital gains tax liability of £1,560. Here comes a very unique concept, that whenever a transfer of an asset is going to be taken place in between spouses or civil partners, as what we have already learned, that this is the case where there is no need to compute gain or loss, because we would assume as if the asset is going to be sold over a price which is equivalent to the cost of an asset in between spouses, and thereby it would not be resulting into any gain or loss. So for instance, if Mr. John has purchased an asset for £40,000 and then he transferred the asset to his wife for, let's suppose, £75,000. As you can see that the transfer is going to be made in between spouses, which is why we will not have to compute any gain or loss, because at this point in time we will assume as if the asset has been disposed to other person over its cost. So we'll take an assumption as if disposal is equal to £40,000, which is the cost of this asset. So if the cost and disposal proceed of an asset would be equal, then there would not be a case of gain or loss over the disposal of such assets. And now as the asset is with Mrs. John, she is the person who has now received the asset, so she would consider as if she has acquired the asset for £40,000. She'll be considering as if she has acquired the asset over the same cost for which her husband has originally got it. So whenever in the future she's going to make a disposal of this asset to someone else other than Mr. John, then against the disposal proceed of the asset, she will have to deduct the cost of this asset, which is £40,000 for her. So that would give the spouses to apply some opportunities related to the reduction of capital gains taxes. As in, if Mr. John has made other disposals in the tax year and he has already consumed his annual exemption amount of £12,000, while his spouse has not made any disposal, which is why her annual exemption amount is still available. So by giving away an asset from Mr. John to Mrs. John would actually be given an opportunity to deduct the available figure of annual exemption against the future disposal of asset which would be made by Mrs. John, and thereby the taxable gain is going to be reduced, and eventually this would be creating a lower figure of tax liability. And there's another planning opportunity which spouses can be able to have by making a transfers of assets in between them, and that is to utilize capital losses and to bring down the value of taxable gain and hence the figure of tax liability. The utilization of capital losses is the concept which is very important, and this will have to be discussed later.
If you like this video, visit our website www.skansecampus.com to purchase the complete course at affordable prices. Register today at no cost and access our free 10-day trial.